morning. Before going into the presentation, so there is a huge tension between India and Pakistan. The situation is getting escalated day by day, and many clients are asking me whether to hold the shares or sell the shares, and they are asking me, and in our office also we are getting lot of calls. So no one knows how far the situation escalates, and it's a very evolving one. And what we generally used to tell our clients is that suppose your risk appetite is very less, you could not be able to digest 20 or 30% fall in portfolio, means better you sell some shares and keep in cash. So by selling 10 or 20%, overall on return wise, it is not going to make much change. But what will happen is that when market falls, since you will be in cash by 10 or 15%, it will give some psychological comfort. You won't get panic. That is the advantage, you will get it. The other problem with selling the share is that once you sell it, what used to happen is that most of the time what we sold, the price used to fall. But we don't know when to buy back it. You would have sold the shares at 100 rupees, the price will fall to 90 rupees. And from 90 again it will go to 92, 93. And what most of them will do is that they will again wait for 90 to come to buy back. But most of the time the 90 won't come. Again it will gradually go up, and it will go to 100 and 105, like that. It will start going up, and most of them won't get the opportunity to re-enter. Even the price would have fell after we sold. So that is the issue for selling the shares again, buy back it. See, many mutual funds, SDFC, many mutual funds which were started during 1995, 96 and all, they issued at 10 rupees. Now their NAV is 2000 rupees, 2500 rupees, like that. Many mutual fund NAVs are there. But I haven't seen that during any crisis time they have sold their portfolio completely, or they sold 50% of their portfolio and then again they bought it back. I haven't seen it. But still they, on long term, they have created enough wealth. So that is the point. When you are investing for long term, the short term loss you have to bear it, and if you don't have that risk appetite, means you sell some shares for psychological comfort. That's what we are recommending to our clients. And coming to the presentation, if you see that market is mostly on consolidation. During the trade tariff, market fell sharply, then again it bounced back. Now for the past few days we are seeing some consolidation. In spite of Indo-Pak tension, market hasn't dipped much. Market actually has not discounted the situation of full war. Suppose if full war comes, market may fall by 10-15%, that may happen. But as of now, market hasn't discounted. Whereas the Trump tariff, market has fully discounted, and if further negativity unlikely to come from tariff from US. And some of the plus point which has happened is that the crude oil prices fell very sharply in the last 1.5 months. If you see that crude oil price fell very sharply from 75 to $80 Brent crude. Now it has come to $60. It is very positive for our country as we import heavily our crude oil needs. So that is very positive. That has happened. And foreign institutions who were continuously selling from October to March, they have been continuously selling. From mid-April onwards, they have started buying it. Yesterday they have sold it, but till before that, if you see that for the last from April mid to May first week, they were buyers on daily basis. In spite of very weak global markets and other negative news, they were continuously buying it. So the negative of foreign institutional selling from October, that has gone now, and they were buyers. That is one positive has happened. And if you see in the broader market, in spite of market revival and many mid and small caps, they continue to fall. Market breadth, if you see that most stocks are falling in spite of market revival. I expect that that trend will continue. So in the last 3-4 years, what happened was that many mid and small caps, SME stocks went up without any rationale, went to huge valuations, and that has been now correcting to normal levels. I expect that that will continue to happen. Other than that, if you see even good stocks which were trading at abnormal valuations of 70 PE, 80 PE, some companies like Astral Pipe, Kajaria Ceramics, these were trading at very high valuations. These are good companies, but because of very high valuations, they are correcting it, and I expect that they will continue to correct. In spite of strong fundamentals, these stocks will continue to correct because of lack of growth. That correction will continue to happen on one side of the market. But select stocks continuously going up, and if you see in the large cap, some of the telecom companies like Bharti, Airtel and all, they are doing well, and by some of the banks stocks like HDFC Bank, ICICI Bank, these stocks are and all doing reasonably well. So overall, if you see that it's a mixed market where some section is doing well and some section is doing very badly. But if you are a stock picker, your portfolio might not have fell much, even though it hasn't gone much. It's not like a panic situation, or it won't feel like a bear market. And index wise, if you see that Nifty and Sensex mid cap, all they have gone up by 5% in the last 1 month, whereas BSE small cap 2%. So some underperformance is there on the BSE small cap front. And this is the cross border tension. So after many years again we are seeing it. So in Pahalgam, what happened was that some 5 terrorists came and they killed around 25 innocent citizens of our country. One belongs to Nepal, and just they shooted and killed it. And it is the biggest, worst attack on civilians since 2008 Mumbai attack. So 2008 Mumbai attack was a very bad one, because at that time already market was doing very badly because of global financial crisis. Along with that, this terrorist attack also happened, and our market reacted very negatively at that time. And based on that, what happened was India-Pakistan standoff got worsened, and India continuously saying that all these terrorists are coming from Pakistan, and Pakistan officially running many terrorist camp. They are allowing to run their terrorist camp full-fledged there, and India wants that the terrorist camp has to be removed from that country. That's what India is requesting them. And after that attack, immediately what happened was that India suspended this Indus Water Treaty, which is a multi-decade treaty. Even during war, 1971 war, 1968 war with Pakistan, India did not suspend that treaty, but this time India has suspended it, and it will have a long-term negative impact on Pakistan. Near term, it won't have much impact. What will happen is that India cannot stop that water for continuously for many days as of now. India has to construct new dams. That will take some time, but it will have some negative effect on Pakistan in near term by closing the dam and opening suddenly. That will make them they could not use that water fully. That India can do it as of now. And first time what I am seeing in the last 4 or 5 years is that retail investors have turned cautious, and some of them are getting panic also because of the war situation. Even during previous correction like a tariff war and even during COVID time also, we haven't seen this type of panic from retail investors. In the last 4 or 5 years, first time I am seeing that many retail investors are getting somewhat scary and scared, and they are feeling very cautious after this terrorist attack and this Indo-Pak tension. And but mutual fund inflows, that is continuing in spite of all this negative. Mutual fund inflows till then it is strong, but in the next 2 months we have to see how retail investor behavior will be. So post that innocent civilians were killed, India did an attack on the terrorist camp in Pakistan at 9 locations. But India carefully did that it is on a terrorist camp only. It was not done on military and civilians. So India did that. In retaliation, for the last 2 days, Pakistan, a huge cross-border shelling is there, and both sides, lot of firing is happening. So market reaction, if you see that during any war news, initial reaction will always be negative. During Kargil war 1999, it was there. Market fell very sharply at that time. At that time, Nifty was less than 1000. For 5 years, market was doing very badly at that time, and Nifty was less than 1000. So when Kargil news came, market reacted very negatively. But after some few days, once the situation got normalized, again market went up. But this time we have to see how the situation escalates. Suppose if situation escalates beyond our control means, then market will see some negativity, some fall we can expect it. And in our opinion, that big escalation unlikely. That is our opinion. We don't know, but what will happen, because what many are saying is that in Pakistan there is no government in place to guide it. Only military has more power. So the military most of the time they try to have war, and they try to create more problems to India. That's what they prefer to do it. And if that is the situation means, then lot of escalation may happen in coming days. And so this is some of the scenarios which we are expecting. So the tension ends for some few days of war like this, and then tension ends only at the LOC. Some firing is happening means, then market will become normal. Then it will start moving based on the fundamentals of the economy and the global news. It will start moving in that way. But suppose if war prolongs with heavy fight other than in border areas, then market will be sideways only. Big upside unlikely to happen, because daily some news will come, and most of the market participants may not be knowing whether it will escalate or not. So most of them will take cautious view, and the market mostly will be on sideways. But suppose if the war prolongs with support from other countries, Pakistan keeps on getting arms from other countries, and there is a huge fight happening means, then we may see some negativity happening in our market. Market can easily correct by 10 to 15%, can easily correct, that is on index level. And broader stock prices, it depends upon the stock. Some stock may fall by 5%, some stock may fall by 20-30%, it may fall. And this is the India VIX, where the premium option premium has spiked in the last few days. So generally, if you see that in the last many months, Indian VIX was at a very low level, around 14, 13 like that. But now only after the war news came, we are seeing some big spike is happening on the VIX level, which indicates that the option premium is going up. That means many are expecting that the market is going to be volatile, and market possibility of market fall is there. That is why people are ready to pay more premium for buying put, and the expectation that market may fall. That's what it indicates. So what investors should do? That is the big question everyone is asking. As I said in my first that if you are a very conservative investor, don't want to take risk, and you are not ready to see it a 10 to 20% loss in your portfolio means, better you sell some part of the portfolio so that if huge escalation happens, is market falls means, you won't get panic, because you are holding some 10-15% cash you are holding, you will get some comfort on that. Suppose if market no escalation happens, market goes up means, you can buy at that time, but you may have to lose some returns in that, but keeping some cash will give psychological comfort. Based on the one risk profile only, you can able to take a decision. In coming days, this cross-border tension tariff war will make situation uncertain, because this tariff war still not ended. US China likely to talk next in coming days, and we have to see what they are going to take decision. And cross-border tension may continue for some more time. Immediately it's not going to stop. And what I have seen in my experience is that in the last 30-40 years, only during this huge uncertain time only, many high net worth investors who have made huge money in the market, they generally used to buy when there is a huge negativity in the market. They buy heavily, not at the time when the market falls by 20 or 30%. When the market falls by 20%, what used to happen is that you will try to see only negative news at that time. These ultra rich investors who made huge money in the market, they generally bought during this heavy negative news time only. They bought it and they made money. Rakesh Jhunjhunwala, when 2000 market fell, 2000 after dot-com bubble, 2001 and 2 market was heavily down at that time. Most of the mid caps were trading at 3 PE, 4 PE, good companies were trading at 3 PE, 4 PE, like that, at a very ultra low valuation. All the news were negative, global markets were down, foreign institutions were not active. During dot-com bubble, many retail investors lost most of their money because a company like Silverline, Rolta India, Pentafor Software, which were trading at 3,000 rupees, 4,000 rupees, 2,000 rupees, they all have become 10 rupee, 15 rupee like that. That means almost 90-95% of the capital was wiped out during that time for many retail investors. So during that time, Rakesh Jujunwala was very active. I know that he bought lot of companies at that time, and when 2003 to 7 bull market came, he multiplied his money by many times. He did it. So when things are extremely negative, if you buy at that time, two things are there. Suppose if market further falls, means you won't lose much money because market has already down heavily. From there further fall, maybe few percentage point will be there. But if it goes up, you will make huge money. So the margin of safety will be very high when there is a huge negativity is there. And US tariff update, US is saying that they are negotiating with multiple countries for tariff finalization, and yesterday, day before yesterday, they have finalized with the UK, and India and US are talking continuously. Most probably in next 2 or 3 weeks, most probably with India also they may finalize broader terms that may come. For China, negotiation has to start. Most probably it may start in next couple of weeks. It will start, and right now China has the highest tariff. It is at 145%, and what we are seeing is that import from China is coming down, and in the month of April the container booking, it has fell by almost 60%. It has fell, the container booking from China to US, it has fell by almost 60%. That means that much of import has been stopped from China. That is what it has happened, and many are telling in US, they are telling that most probably in the next 1 or 2 months most of the stocks will be sold out, and there will be lack of stocks in US. And US Fed, they remain cautious. They are not going to reduce the rate in a hurry. They may wait for a few months and they see how this tariff will pan out, and post that only they will take any rate cut decision or rate decision they will take. See, replacing China is not an easy. They have built a huge manufacturing base in the last many decades, and replacing a Chinese product in the next 6 months or 1 year is impossible for any country. It will take some decades to replace Chinese product. Even if you see that in the last 5 years, China trade surplus has doubled in the past 5 years in spite of COVID. China trade surplus was less than 0.5 trillion. Now it has come to 1 trillion. That means they have sold another 0.5 trillion worth of goods to the entire world. In spite of COVID issues and slowdown, COVID was there. Even China was affected by COVID. In spite of that, they increased their trade surplus with other country, and other countries is they have increased the export. So it is the manufacturing hub of the world, and replacing will take a lot of time. 4 days back, Trump told that for building a pharmaceutical plant in US, it will take 5 to 10 years. They are telling that too without this supply chain. Where you have to get US FDA approval for building the plant. You need machinery. If you order machinery now, you will get. It will take 2 years, 3 years. It will take to get it. After that, after installing, after build the entire manufacturing base, you have to get FDA approval from that. FDA inspection will be there. Then you need raw materials for making that pharmaceutical. So for building a full-fledged pharmaceutical plant, it will take 5 to 10 years. That's what US president itself is saying. So to replace that, you see how many years it will take to replace a pharmaceutical product either from India or China. Just by putting tariff, you cannot replace it. It's not an easy product. It will take lot of time. So similarly, products from China, whether you like it or not, it will take lot of time. Gradually only we could be able to replace it. Crude oil prices, now it has come to $60. It went to $120 during Russia-Ukraine war, and gradually it fell. It used to trade around $80. Now in the last 1.5 months, it fell very sharply from $80 to $60. It has fell. So it has given some benefit to us. So two institutions which are going to give support to our market is in coming days, which is a medium term view, is that one is that RBI. It looks that RBI is extremely dovish, and they are giving whatever support to the economy they are giving. Even 2 weeks back also another open market operations they have announced it, and they are giving our economy enough liquidity. They are providing it. RBI surplus liquidity in the economy they want, so that the recently 2 interest rate drops they did it on repo rate 0.2 0.5%. So they want to quick transmission of rate cuts. That means you need enough liquidity in the market for rate cuts to get transmitted. For that, whatever support RBI needed, they are doing it. So SEBI also, new SEBI chairman also is very cooperative, and he wants that compliance to get reduced. Recently, in the last 4-5 years, what happened was that huge compliance burden was there on the both on the clients as well as on the market intermediaries. But recent new chairman has said he wants to reduce unnecessary burden to the market participants as well as to the intermediaries. They are working on it, and these measures will invite more investors to the market. Both RBI and SEBI is likely to give huge support to our market. That's what we feel. RBI will give support to the economy, which will affect the corporates positively, and SEBI for market participants and intermediaries, so that they will try to do maximum so that more participants will come. And another interesting thing which is happening in the bond market is that bond yield difference between US and India has narrowed significantly. See, now just 2% is there. Previously it used to be around 4%, the bond yield difference will be there. Bond yield difference is nothing but if you take 10-year bond yield of US and 10-year bond yield of India, if you take, that difference will be there. It used to be, historically used to be around 4%. So this 4% what used to have is that Indian currency used to depreciate 4% on an average on a long term period. Now that percentage has come down. So US bond, 10-year bond is trading around 4.3% yield, whereas Indian bond, if you see that, it is around 6.3. That means the difference is 2%, which means that Indian currency will be much more stable than what it was seen previously. Huge depreciation unlikely. Indian bond yield fell very sharply, whereas US at the same place. So that is why the difference has come down. And Rupee also has recovered. It went to around 88 level. It went to, now it has recovered a lot. It is around 85. Friday it depreciated little bit because of this war news. This is a very important chart. If you see the number of stocks making 52-week high or low, even though the market has bounced back, and if you see that the number of stocks touching 52-week low is much higher than number of stocks touching 52-week high. The green one is 52-week high and the red one is 52-week low, which indicates that in broader market still pain is there. Even though the index has bounced back, many mid and small caps they are still seeing the fall. That is why these companies are seeing 52-week low prices. So the broader market still some lot of distribution is happening, whereas on index level, if you see, it is somewhat better on index level. Buyback, this is one important thing which the government has done a mistake. Generally during a huge uncertain time when everybody was negative, previously what used to happen is that many companies will announce their buyback and they give support to their stock price and give exit to investors. But last year what happened was that the tax calculation on buyback has been changed. Buyback has been considered as a deemed dividend, which means that the full amount of whatever amount you are getting on buyback, it will be taken as a dividend and it will be taxed on the slab rate. That changed. Previously companies used to pay tax on the buyback. That was changed last year. So post that announcement, from October onwards, the buyback has come down very sharply, and this is the offer amount. This is the buyback actually done. If you see in FY24, almost 50,000 crores of buyback was done. Mainly it was supported by TCS. They did a huge amount, and even before that 21,000, 31,000, 35,000, like that huge buyback corporates did it. Even many PSU companies also did buyback at that time. Companies like Moil and all, they did buyback. But in FY25, if you see, the amount has come down to 8,000 crore. In FY26, most probably it will be very few thousands will be there. FY26 also, because of the change in buyback tax structure, this has come down, and government has to correct it. At least in the current budget, they would have done it. They haven't done. Maybe in the next year they may do it, because if buyback is seen as a deemed dividend, it means no other country does like that. In US, if you see that most big companies, they tend to do buyback throughout the year. A company like Apple and all, every time they announce 50 billion of buyback, 100 billion of buyback, they announce it, and they will give, and it will give exit to the shareholders, as well as it will give support to stock prices. Particularly in India, if you see many mid and small caps, this buyback will give good support to the stock price, where the liquidity is very less. So government has to correct it. I hope in the next budget they will do it. Generally, this war situation like that, if market falls very sharply, means many companies are sitting with huge cash. They can easily announce it that balance sheets are supportive to make buyback, but because of this unfriendly tax structure, they won't do it. Most probably in the next budget, government should correct it. And Q4 earnings, companies are announcing Q4 earnings, and I see that some improvement is there, even though on an absolute basis, if you see on the number wise, we may not feel that much improvement is there on an aggregate basis. But on a company wide level, if you see that Q2 was very bad, that two quarters back, Q1, Q2, Q3, Q4, 4 quarters were there. Q2 was the worst quarter we had it, and Q3 some stabilization was there. In Q4, which is now, what we are seeing was that some improvement in earnings was there in many companies. That's what I see it. So fundamentally things are improving, and gradually it will improve from here only. Maybe war may have some deterrent, but other than that, the worst earnings slowdown phase is over on Q2 FY25. And if you see that the sales out of 421 companies, sales was around 7%, profit was around 9%. The same thing last year was 7%, and profit went up by 17%. But after that, what happened was that June 2024 and September 2024, the earnings was very bad. Nifty earnings was just 5% at the 4% at that time in the second quarter. Now slowly the improvement is happening. Q3 was around 6%. Maybe Q4 Nifty earnings may not be much higher, but many companies which are doing well, they may announce a decent growth. So things are improving. And our expectation is that the domestic oriented companies to do well, because in the last budget what happened was that government has given IT exemptions. It will give some support to the consumption, as well as what we are expecting is that RBI likely to give huge dividend to government. Last year also they gave big dividend. From last year dividend, another big hike can be expected this year also. So government balance sheet is strong, they can spend more money, and overall domestic oriented companies to do well. On export oriented companies, IT company may see some slowdown, because in US there is a big uncertainty is there, and even the big IT companies commentary is not so strong. So the export oriented IT companies, they won't do well. They may show some 5 or 6% growth. Pharmaceutical, they may do reasonably well. Whereas domestic oriented companies, we are expecting to do well. RBI is also very supportive, and the corporate performance is going to be divergent. It's not that all companies to do well. Some companies to announce good results, some companies may see slowdown further. Even this GST collection growth also, you can see it. Generally GST collection on a normal economy used to be around 12% growth when compared to last year. Our economy is 6 to 7% growing, plus the inflation of 5 to 6%. So 12% growth in GST is a normal in our economy. Anything less than 12% growth means the economy has slowed down. That's what we have to take it. Anything about 12% growth in the GST collection means economy is doing above normal. And if you see that last year during the August, September, October period, the growth of GST collection fell very sharply. Around 8%, 7% it came. Now that also started going up, which indicating that economy is recovering. The GST collection growth indicating that economy is recovering. Previously this 12% is a normal growth. And domestic institutions, if you see that almost the DIA holdings and the FI holdings are almost equal now, around 16.9, both are holding. If you see in 2009, where domestic foreign institutions they were holding 11%, it gradually FIs they are holding 13.45%. It gradually went up, and in the last 2, 3, 4 years it has come down. But a domestic institution, if you see that in the last 4 years it has started going up, mainly because of huge participation by our retail investors through mutual fund. That is the reason why the domestic holdings has gone up, and now both are almost equal now. And this is one interesting subject, this gold and silver. See, everyone knows that gold prices has gone up very sharply in the last 2 years, and has given huge return. If you see the 2-year return, 5-year return, gold has given very good return to investors. But those who are in the market, what we have seen is that those who do huge analysis, fundamental analysis and technical analysis, most analyst people and most investors have done that. Instead of gold, many of them has bought silver and hoping that silver will do well. But unfortunately, what happened in the last 1 year, 1.5 years was that gold has outperformed silver a lot, mainly because of various issues. Gold prices went up because of huge buying by various central reserve banks. Because of that, gold price went up. But silver has underperformed a lot. And if you see that gold silver ratio, where many used to follow it, if you ask anybody who bought silver 2 years back, they would have told that I am buying silver because the gold silver ratio is in the favor of silver. But after that only gold silver ratio has still got worsened. And in the past, if you see that historically, if you see that gold silver a couple of times went up very sharply. Price went up by 2 times, 3 times within a short period of time because of huge speculative buying. So if you see the technical chart, many were thinking that the same type of spike may come in silver any time, and based on that hope, many bought it. But that hasn't happened till now. And if you see the fundamentals of gold and silver, and this is the big table. It has been taken from a DSP, their website, their presentation, and a lot of data are there. You can, in our presentation when we mail, you can go through it. It's a very interesting one, and they have given why gold price is going, what are the fundamentals of gold, what are the fundamentals of silver, what will be the scarcity implication, everything they have mentioned. And a lot of interesting data is there. See, gold generally it is driven primarily by organized mining. So lot of gold mining companies are there globally. Whereas silver, most of them don't mine any silver. What they do, how you get silver is a byproduct of mining other metals, and hence is a low supply price sensitivity. If you take a company like Hindustan Zinc, it's a listed company. They mine zinc, but during the zinc manufacturing process, they get lot of silver also. So it's a byproduct. Silver is a byproduct. It is not mined directly. Most of the silver, whatever we are seeing throughout the world, is a byproduct of refining other metals like zinc, copper, like that. So the production is different. Gold is directly mined, whereas silver is not mined. It's a byproduct. So like that, lot of interesting data is there. And main thing why gold price has went up now is that it's a primary sovereign reserve asset. Every country will own gold as a reserve asset. 2 years back when Russia-Ukraine war came, American government frozen the Russian dollar assets completely. So at that time, what other central government banks thought that anytime US has the power to freeze the dollar asset. So why should we buy and keep a dollar? So we can diversify into gold. So at that time only the real bull run of gold started. So that is the main reason why gold price has gone up. Whereas silver is not a reserve asset, even though some countries are still, a country like Peru and all still hold it as a reserve asset. Even China also hold it as a reserve asset. So if you want gold price to silver price to go up means central banks has to buy it. So that would be the big trigger for silver price to go up. Otherwise, we have to hold the silver on hope only. Even though in the last 4 years there is a huge deficit of silver. That is a difference, sir. In 1990s or 2000 and all, the platinum price used to be higher than gold price. Now it is just 1/3. At that time, I know that many of them used to buy platinum. They use as jewelry, platinum jewelry. It looks like silver only. They buy it, and their price is 20% higher than gold price 30 years back. Now, if you see that platinum is 1/3 price of gold. Some buyers has to come. In gold case, the buyers were mainly the central banks they were buying. Other than that, many retail investors, many retail jewelries, from India and all having the demand. Diamond is a different story. FIs, if you see that after many months, they have turned to buyers. From October onwards, they were selling it, and March end it was flat, and April 2nd week onwards they turned buyers. April first 10-15 days they were sold. From 2nd to 3rd week onwards they were buyers, and yesterday they were big sellers. I too expected yesterday they will be selling. As expected they sold it, and if you add that, the net figure will come to around 8,000 crore only. Mutual fund, and March it was around 25,000 crores. April also 25. April data came yesterday only. I didn't add it. So April also near to that, around 800 crores less than March data. And SAP is still continuing. Last month SAP, April month SAP was all-time high, almost 26,000 crore SIP flow is there. So that will give some support to the market. Events, so the main event is this cross-border tension. How far it goes, we have to see it. Then Q4 results, then US trade agreement. These are the ones we have to track it. Thank you.